Between September 1929 and July 1932, the American stock market lost a staggering 85% of its value. I mean, think about that for a second. It's a number so massive it almost loses its meaning. But that phenomenal loss of wealth, well, that was really just the beginning. Welcome to our explainer. Today we're going to get incredibly detailed. We're going to look very closely at how a localized financial crash mutated into the absolute most catastrophic global economic contagion of the 20th century. We're essentially performing an economic autopsy of the Great Depression here, relying entirely on the granular data and the specific historical mechanisms that drove the entire world into a decade of despair. Let's dive in. Okay, let's treat this event like a meticulous autopsy so we can truly understand the fatal mechanisms at play. First up, we'll examine the 1929 initial shockwave, followed by the anatomy of a collapse. Then we'll trace the global transmission and tariffs, weigh the competing economic diagnoses, track the worldwide contagion, and finally, we'll chart the path to global recovery. Section 1. The 1929 initial shockwave. So, we begin our investigation with a really crucial question. How exactly did a stock market crash trigger a decade-long global economic collapse? We often conflate the crash of 1929 with the Great Depression itself, but separating the two is vital. The crash was really merely the initial symptom. It was a massive hemorrhage, yes, absolutely, but not the ultimate cause of death. You see, the underlying condition had actually been brewing for a while, through the wealth inequality and massive speculative borrowing of the Roaring '20s. The initial cascade happened terrifyingly fast. It kicks off on Black Thursday, October 24th, with an 11% drop right at the opening bell. And despite some frantic attempts to stabilize the market, panic just completely set in. Black Monday saw another 12% drop, and Black Tuesday followed right behind with 11% more. Literally, billions of dollars vanished in a matter of hours. But here's the thing, the real mortal wound to the wider economy, that didn't hit critical mass until December of 1930. Section 2. Anatomy of a collapse. Let's look at the internal bleeding of the economy. 9,000. That is the staggering number of U.S. banks that failed during the 1930s. When the stock market crashed, terrified depositors obviously rushed to withdraw their money, but banks only keep a fraction of deposits on hand, right? So they suddenly had to call in loans, and the borrowers, well, they had just lost their shirts in the crash, so they couldn't pay. This dynamic created a massive, system-wide freezing of capital. A perfect example of this is the Bank of United States. This was a massive, privately run New York bank. When a bank run forced it to literally close its doors in December 1930, it alone accounted for a third of the total $550 million in deposits lost across the entire country over just a 2-month period. Because it was unable to pay its creditors, its highly publicized failure just completely shattered public confidence. It caused a lethal contraction of the total money supply as people gave up on banks and began literally hoarding cash. Section 3. Global transmission and tariffs. So how on earth did American banking crisis infect the whole world? Well, let's look at the accelerants that choked trade and forced the depression onto other nations. A crucial piece of this puzzle is pure policy failure. In a totally misguided attempt to protect domestic industries, the U.S. passed the Smoot-Hawley Tariff Act in 1930. This raised import duties to an average of 50%. And the result? An absolute catastrophic backfire. Other nations immediately enacted retaliatory tariffs. American exports basically fell off a cliff, collapsing from $5.2 billion in 1929 to just $1.7 billion in 1933. Global trade was essentially choked off, shrinking to a third of what it had been. Then we have the primary transmission mechanism itself, the gold standard. I want you to think of the gold standard as the rigid, fixed plumbing of the global economy at the time. If one country raised interest rates and pursued deflationary policies, gold would naturally flow out of other countries to chase those higher yields. So to stop their gold reserves from bleeding out, those other nations were rigidly forced to shrink their own money supplies and deflate their own economies. It acted exactly like an economic virus spreading through fixed exchange rates. Section 4. Competing economic diagnoses. Now, if we're performing an autopsy, we really need to consult the expert pathologists. Why was this depression so incredibly deep and prolonged? Our historical sources present two incredibly detailed yet competing diagnoses. On one side, we have the monetarist view, famously championed by Milton Friedman and Anna Schwartz. They argue this was really just a normal recession that turned into a depression simply because the Federal Reserve sat idly by. They failed to inject liquidity, which allowed the money supply to violently contract by 35%. On the flip side, you have the Keynesian view, originating from John Maynard Keynes. This view argues that private sector demand entirely collapsed and that only massive government deficit spending could replace that lost consumer demand and actually pull the economy out of equilibrium at such high unemployment levels. And there's another fascinating, super detailed layer to this, Irving Fisher's debt deflation theory. This breaks down the granular mechanics of the whole doom loop. You see, when prices and incomes fall, the actual dollar amount of your existing debt doesn't magically change. It stays the same. So paradoxically, the more assets people desperately sold to pay off their debts, the more the money supply contracted, which drove prices down even further, making the remaining debts mathematically heavier. It was just a vicious, self-aggravating downward spiral of bankruptcies.
Section 5. The Worldwide Contagion.
Let's track the specific metrics of how this economic virus infected the rest of the world, because the sheer scale of the global devastation is mind-blowing. While U.S. industrial production basically halved at negative 46%, Germany's drop almost exactly mirrored it, plummeting 41%. The UK and France were slightly more insulated, sure, but they still suffered near-quarter drops in their entire industrial output. And the suffering was deeply unique, depending on the region. In Germany, where American loans from the 1920s suddenly just dried up overnight, unemployment hit nearly 30%. This created severe political upheaval that directly paved the way for Adolf Hitler's rise to power. Down to Latin America, countries that were highly dependent on single exports were absolutely devastated. Chile's GDP literally halved simply because 80% of its government revenue came from copper and nitrates, which suddenly had zero global demand. European colonies in Africa saw agricultural prices plummet, and the UK, they were forced to abandon the gold standard entirely in 1931 just to stop investors from completely draining their gold reserves.
Section 6. Path to Global Recovery.
So we've examined the cause of death. Now let's look at the resuscitation efforts that slowly and very painfully brought the global economy back to life. Remember that gold standard virus mechanism we talked about? Well, the data clearly shows that the earliness with which a country abandoned that rigid gold standard reliably predicted how fast its economy broke the deflationary grip and recovered. The UK and Scandinavia dropped it in 1931 and recovered relatively early. The US painfully held on until 1933, enduring a much longer slump. And the so-called gold bloc, which included France, clung to it all the way until 1935 and 1936, suffering severely prolonged economic stagnation as a result. Now, there is a highly detailed explanation for the U.S. turnaround specifically, known as the expectations hypothesis. When Franklin D. Roosevelt took office in 1933, short-term interest rates were already close to zero, yet no one was investing. Why? Because everyone expected prices to just keep falling. But by abandoning the gold standard and pushing a massive regime change, Roosevelt successfully shifted the public's psychological expectation from severe deflation to mild inflation. Suddenly, people actually believed their future incomes would be higher, which endogenously stimulated demand and got people investing again. But it's worth noting there's wide debate over whether the New Deal's policies actually cured the Depression or if they just sort of alleviated the symptoms. Even Keynes himself doubted the political feasibility of his own theory during peacetime. He famously stated, it seems, politically impossible for a capitalistic democracy to organize expenditure on the scale necessary to make the grand experiments which would prove my case, except in war conditions. And he kind of hit the nail on the head, because the consensus among economic historians today is that it was the massive mobilization for World War II that finally drove a stake through the heart of the Great Depression. By 1943, the government accounted for a staggering 67% of all U.S. capital investment. This completely absorbed millions of unemployed men into the armed forces and the factories that supplied them, functionally eliminating the remaining economic rot. Which leaves us with a critical, final thought to chew on. We've just performed a deeply detailed autopsy of the 1930s, from the severe contraction of the money supply and the domino effect of banking failures, to the rigid constraints of the gold standard and the devastating folly of retaliatory tariffs. We know exactly how a localized crash mutated into a global catastrophe. So the question is, having mapped out these highly granular, fatal transmission mechanisms in this explainer today, will we actually recognize them when the next massive economic shockwave inevitably hits? Or are we just destined to repeat the exact same mistakes? Thank you so much for joining me, and as always, keep questioning the data.